What if I told you most people spend years trying to pick the perfect stock, only to lose to something ridiculously simple? No secret formula, no insider tips, no Wall Street genius required. Just one decision that separates average investors from the ones who quietly build wealth. And today, I'm breaking it all down in the simplest way possible. Look, if terms like index funds, ETFs, mutual funds, or hedge funds ever made you feel confused, you're not alone. But by the end of this video, you'll understand exactly what each one is, how they actually work, and most importantly, which one is right for you. No fluff, just clarity. Let's start simple. Imagine this. You and 10 friends want to invest, but instead of each person figuring it out alone, you all pool your money together. Now suddenly, you can invest in stocks, real estate, and bonds all at once. And instead of managing everything yourself, a system or a professional handles it for you. That's a fund. It's basically teamwork for investing. Less stress, more diversification, better chances of long-term growth. Now here's where things get interesting. You've probably heard this advice. Just invest in index funds and chill. But what does that actually mean? An index fund doesn't try to beat the market. It simply becomes the market. Think of it like copying a leaderboard. For example, the S&P 500 tracks 500 of the biggest companies in the US. When those companies grow, your investment grows. No guessing, no stock picking, no stress. And here's the best part. Because no one is actively managing it, fees are extremely low, sometimes as low as 0.02% per year. That's basically nothing. And over time, low fees make a huge difference in wealth. One more thing most people don't know. You don't buy index funds instantly. Your order gets processed at the end of the day. So it's not about timing, it's about staying invested. Now, pause for a second. If investing really is this simple, why do people still overcomplicate it? Let's talk about that. Enter mutual funds. These are similar, but with one big difference. A human is in charge. A fund manager actively picks stocks, times the market, and tries to outperform everyone else. Sounds great, right? But here's the reality. Most of them don't beat the market long term, and they charge much more. Typically around 0.5 to 1.5% per year. That might not sound like much, but over 20 to 30 years, that can cost you tens of thousands of dollars. Still, some investors choose mutual funds for specific strategies, certain sectors, or belief in a manager. But remember, you're paying for that bet. Now let's step into a different world. Hedge funds. This is where things get aggressive. We're talking borrowing money to invest, betting against stocks, and using complex strategies most people don't understand. These funds aim for big returns, but they also carry big risks. And the fees? 2 and 20. 2% management fee and 20% of the profits. Yes, they take a cut of your gains. That's why hedge funds are mostly for millionaires and institutions, not everyday investors. Now this is where things get powerful. ETFs, exchange-traded funds. Think of them as index funds, but with flexibility. You get diversification like a fund and real-time trading like a stock. You can buy and sell anytime during market hours. And the fees? Still low, usually between 0.03 and 0.75%. That's why ETFs have exploded in popularity. They're simple, flexible, and accessible. So here's the truth most people need to hear. You don't need complexity to build wealth. For most people, index funds are simple and proven. ETFs are flexible and efficient. Mutual funds, only if you truly believe in the strategy. Hedge funds? Probably not for you. At the end of the day, investing isn't about being the smartest person in the room. It's about staying consistent, keeping costs low, and letting time do the work. Because the real secret? Wealth isn't built overnight. It's built quietly, over years. If this video simplified things for you, hit that like button. Subscribe for more no-nonsense finance content. And if you want to know exactly how to start investing step by step, watch the next video right here.